Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
I'm your host today, Joel Cundick. I'm based in the Vienna, Virginia office, and I've been a financial advisor here for over 10 years. And it's time to talk taxes, which is one of my favorite topics, which makes me an anomaly, I know. But what we're going to try and do today for you is to get through a number of tax strategies that will make a difference for you outside of the traditional tax emergency window, which we're normally looking at somewhere between January and April of each year. What we're trying to do here is expand our lens, and that's why I'm glad you're joining us outside of tax season for this kind of a conversation. So let's see how far we can get in the time we have provided for us. I'll try and make sure that this is as high value to you as we can have. So the first idea with tax preparation is that it's not just preparation. If you get to an accountant in the month of February or March, or if you yourself handle your taxes in February or March, you're going to be working on a deadline. You're going to be working with urgency, and you're just going to be trying to plow through and get things done. So that's not a window for excellent tax strategy. In addition, you're looking back at a tax year that came before. And there's almost nothing, there's a few strategies, but almost none that you can take advantage of once the tax year has closed. So what we're going to try and do today is be more in a planning mindset rather than a preparation mindset. So then when it comes time to prepare your taxes next year, you will be ready. Tax planning is a mindset. It's something you do year round. Most of the activities that are going to impact your taxes are happening throughout the year. And it tends to be the surprises. It's not the same old W-2 income that you have every year or the 1099 div that you're getting from your bank. It is the surprise, the house being sold, the business being sold, the stock compensation being recognized, lots of surprise events that happen through the year that are not handled through the traditional tax withholding methods. So we start thinking about taxes for the new year, hopefully on January 1, but certainly after April 15th, once we've prepared our prior year tax return. So look for the unusual events, looking for when you're going to sell a house, sell investments, get a one-time large bonus from work. All of these things should put up your tax antenna to say, oh, how is that going to impact me next year? Schedule a time, if you have a tax preparer, outside of the heavy volume times. August tends to be a great month. November tends to be a great month. Accountants always have deadlines around September, October, and obviously April every year that they're focused on, and is going to be a time where they're not going to be as strategic in their thinking. So you want to schedule a time to go through tax strategies outside of those windows. All right. You want to always bring to that conversation whatever you have recognized in income over the course of that year. So that means year-to-date pay stub, any bonus information, any, like we've said, business sales on the horizon that have just been completed. These are the kinds of activities that you're going to want to notify them about so you can properly plan. And then you want to make sure that any tax advisor who is working with you is being proactive, not reactive, right? That's why you're going to them ultimately. Tax preparation is great, but tax strategy is a whole lot better, right? One is very different in terms of the impact it can make to you and your personal finances. So I'm going to break things up today into two different sections. We're going to talk about above the line strategies and below the line. What is the line? The line is once we've calculated income, all right? Your adjusted gross income, which is the number from which we're then going to take below the line changes. Why did above the line matter so much? It's because there is a tax ripple effect to anything that you do above the line, because some states, many states, base their tax regimes off of that adjusted gross income number. So if we can get that number lower, that's probably going to help us more than anything below the line. So pay special attention to what we're talking about in the initial phase of this, because this could be the highest impact stuff. You want to take advantage of your preferential capital gain and dividend tax rates. Here are the tax brackets for married filing jointly. So when we talk about above the line strategies, what am I referring to? The first thing that we can do is take advantage of our preferential capital gain and dividend tax rates. You may know this, you may not, but there are different tax rates depending on whether income is determined to be ordinary income or capital gain income. And we have different sets of brackets. So I have up here the tiers for 2025 for tax rates. We've got some particular ones of note to look at here. You'll know, maybe you know this already, maybe you don't, but you'll note that the 24% tax bracket is kind of the end of advantageous ordinary income rates. So all the way up to $395,000, you're at pretty similar income tax. There's a big break for those below $97,000 a year in income as well. And so that could be another tier that you're worried about. Many people listening today are probably going to be above that threshold. But once we jump above $395,000, we enter 8% higher tax rates. So if we're managing income and can keep ourselves under that 395 threshold, that's going to be advantageous to us. Now, there's also a specialized long-term capital gains rate, though. And this means that anything that I've held longer than 366 days is something that I get to deem as a long-term capital gain. Short-term capital gains, all you GameStop traders out there, are always taxed as ordinary income. They're just lumped in with my income at the end of the year, and they can often lead to big surprises because we don't realize that there's no tax withholding being done on that activity. Tax withholding is kind of implicit in the world of employment because it's always happening out of our paychecks. But these surprise events, there's not going to be any tax withholding. We have to take care of that ourselves through a process called estimated taxes. So if we can hold for longer than 366 days, we get the benefit of a 0% tax rate if our income's under $97,000, or a 15% tax rate all the way up to $600,000. You'll see in this 35% tier, it's 15/20. Asterisk tells you the 20% rate on gains doesn't start until $600,000. That said, there's a stealth tax hidden within there called the net investment income tax that kicks in at $250,000. Put a pin in that. We'll have a slide on that in a little bit. So yes, we want to manage income as much as we can. I love the caveat at the bottom of the slide, though. Don't let the tax tail wag the life dog. Taxes are not the be-all, end-all. Realizing gains means that we made money. Selling a business at a gain means we made a lot of money. Owing some taxes on that is okay, as it can change our life in terms of what we're able to spend. So we want to be careful when we get into this tax mode of like, I want to save wherever we can. That impulse to save has been really good for you over the course of your lifetime because it's led to you saving a lot more probably than the average person. However, there can be extremes where it's taken to, where you start to say, oh, I care more about staying under the 22% tax bracket than I do about being able to spend the way that I want in retirement, for example, right? Let's not limit ourselves because of taxes necessarily. At least it shouldn't be the reason in isolation. We have to look at our life in context of the tax effect. But let's have the brackets in our minds when we're doing tax strategic planning so that we can make sure we make the best decisions we can. All right, I said to put a pin in it, there's a net investment income tax. The Affordable Care Act created a 3.8% surtax on investment income above $200,000 for individuals or $250,000 for married filing jointly. That means you think the 15% rate is what you're paying on capital gains. But there's really another tier. Once you cross $250,000, the effective capital gains rate is 18.8%. 15% long-term capital gains rate plus 3.8% Medicare surtax. And that triggers at $200,000 if an individual. Okay. So again, these are things that we can be aware of. If we're close to somewhere around that limit and we can spread gains out over multiple tax years and stay below that threshold, let's save 4% taxes on our activities and bridge across a couple of tax years. So what is subject to the net investment income tax? We're talking about taxable capital gains, dividends, passive income, interest, and then we got another couple that are less common, non-qualified annuity payments and rental and royalty income. The only thing you can get away from in the investment world from the net investment income tax is municipal bond interest. And you have to decide on a municipal bond whether it makes sense to you. Again, I've sat down with folks to look at their tax situation where they're really wanting a municipal bond because you don't pay taxes on the income from a municipal bond. But we look at their tax rate, and actually their tax rate is low enough that they would be better off not using a municipal bond strategy. As, for example, sometimes municipal bonds tend to be priced for somebody at above the 24% tax threshold, the 32 or the 35% tax brackets. So that we have to look at, the only thing that matters in the investment world is what is the after fee, after tax return of any strategy that you're implementing. What are some other things that we can do above the line? We can do a Roth IRA conversion. Now, a Roth IRA conversion is going to do the opposite of what you think you want to do, right? It's going to move taxes into this year as opposed to out of this year. That said, when we do a Roth conversion, we're utilizing it. I'm going to jump back a couple of slides here to be illustrative. We're using it because we're perhaps in the 22% bracket, but by the time we take required distributions, we're going to be jumping to the 32% bracket. And so we get potentially a 10%, 8 to 10% tax savings if we do Roth IRA conversions in this year. This is why I say it's an all-year strategy to look at taxes. It's actually a multi-year approach. We're looking at over the long term, how are our taxes going to be impacted by strategies we choose this year. Sometimes it makes sense to move income out of future years into this year to fill up unused tax brackets, right? Somebody comes to me and says, I'm so happy I've been in the 0% tax bracket for multiple years. I generally cringe. I don't mind somebody paying zero tax. I just know that in most cases, somebody who is in the 0% tax rate bracket is somewhere in their future going to be subject to a higher tax bracket. And we probably could use a 10 and a 12% bucket to fill up a level of taxes and avoid future taxation. Okay. All right, we'll go back to the Roth IRA conversion idea. So now we're allowing for more control of our future years of RMD. So if I have $1 million IRA and I know I'm going to have to take $40,000 per year out when I turn 73, I could at age 65 decide to take $10,000, $20,000 a year out per year from my traditional IRA, move it all directly into a Roth IRA. One of the key elements is that I should have an investment account outside that I can pay with cash the taxes on that conversion, because to really be worth its weight in gold, a Roth IRA conversion should be done in full. So I move the full $20,000 into from a traditional IRA into a Roth IRA. But when I do that, I have to recognize income from that, the whole $20,000. I like to pay the taxes from that for another source to maximize what's going into my Roth IRA. Some of these strategies I can only cover so much in detail as we're going through a presentation like this where I'm wanting to maximize your time. So file this away. If this is a useful strategy potentially for you, I want to make sure that you are looking at this in more detail outside this call. I want to make sure that you are posting a question in the survey that will come out to you afterward today, so that you can make sure you have somebody answer you directly about your questions. So then we can make our portfolio tax efficient. How can we do this? Well, again, I'm not just thinking about a 2025 tax return. I'm thinking generally about how do I have the investments positioned in my portfolio from a tax perspective. High quality municipal bonds, they can be an excellent source of tax-free cash flow. If you're in a high income tax state and you use a municipal bond from your own state, most of those are going to qualify for no state income tax either. In fact, some states have agreements with other states where they will allow you to buy another state's municipal bond and still pay 0% on state income taxes. This is something that you want to look at carefully, particularly if you are in the 32% tax bracket or above. I find that the 24% tax bracket and below, oftentimes we can make more after tax on a taxable bond than we could on a municipal bond. The other thing we want to do is we want to put our investments in the correct accounts. So that's what an asset location strategy is. You've heard about asset allocation. That's for another webinar where we're talking about investments. This one's about tax. Asset location means putting the tax preferred assets in the different buckets where they go. We have three kinds of investment accounts. We have a tax-free account, that's Roth, whether it be 401k, IRA, 403b, that's all in the Roth sleeve. We have traditional IRA, traditional 401k, that's all tax deferred. At some point in the future, I'm going to pay tax. And then we have what's called a taxable brokerage account. That account is going to be subject to those long-term or short-term capital gains taxes we were talking about earlier. So we want to make sure that we put the right investments in the right buckets. Why? I would rather have growth take place in my Roth than I would have it to take place in my traditional IRA. Traditional IRA, every dollar of growth is someday going to be subject to income taxes. Roth IRA, every dollar of growth is never going to be subject to income taxes. And in fact, I can kind of tweak the taxable account to act Roth-like if I'm going to make sure I'm buying investments for the long-term investments I'm not planning on selling. As long as I hold on to those investments to my death, I get what's called a full step up in cost basis. And not only have I deferred my gains, I've avoided my gains altogether because my heirs will be able to sell those investments at no tax to them. So asset location means let's look at the right accounts to hold the right investments. I don't want to hold taxable bonds in a taxable brokerage account. They kick out ordinary income. I'd rather hold them in a traditional IRA or 401k. So examples like that. About that 401k. The maximum you can contribute this year, if you're under 50, is $23,500. Okay. A lot of you are not making that maximum contribution. Now that's okay. If you're meeting your goals, everything's going well, it looks like you're on track for retirement, and you want to take that money and use it towards lifestyle, that can make a lot of sense. Strictly from a tax lens, you might say, well, no, I'd rather get the tax deduction now. I inevitably get the question, well, should I use the Roth or should I use the traditional method of saving into a 401k? My answer is, it depends, always depends. But in this case, it's what's your current tax rate and what do you anticipate your tax rate will be at the time that you withdraw funds? Let me say that again. It's what's your current tax rate and what is your tax rate that you anticipate you'll pay at the time you withdraw the funds. One of those is a known. One of those is a complete unknown, unfortunately. We do have a sneaking suspicion that tax rates will generally rise in this country. So I work with a number of people who tend to like the Roth strategy just because they are concerned that taxes will be higher in the future. But if you're in your 50s and 60s and you're earning a lot of money in your current employment, there's a good chance you're going to drop to a lower tax bracket in retirement. That would mean you'd want to take advantage of every dollar of deferral you can get. It's not so that you can save more for retirement. If that were just the only reason, I'd say save into a taxable brokerage account. The tax situation is going to be better. But what I'm doing with this 401k or 403b or TSP or IRA, I am putting money in to be able to be taxed later. It's an income deferral strategy. I move income out of high tax years into low tax years. If you're 50 or over, you can contribute an additional $7,500. And I'll put a little asterisk in here. If you are between the ages of 60 and 63, you get a bonus this year. You can put in another $3,750 above that $7,500 catch-up. This is called kind of the additional catch-up provision for people nearing retirement. It's made things more complex. If you're in a situation where you're trying to get every dollar of tax deferral you can, that's a strategy you want to look at. And even if you haven't been deferring that much in this tax year, you can still up your contributions into that retirement account so that you maximize by the end of the year. So taxpayers who are not taking advantage of their company's 401k match, this is a little plug. I know it's not tax specifically, but I can't help but saying if you get a 50% or a 100% match on your contributions to your retirement plan, that's a better guaranteed investment return than I can find you anywhere in the investment universe. So please make sure you're at least taking advantage of the match available to you. All right, what else can we do to affect income above the line? We can donate our IRA to charity. And some of you are like eye-popping, and I have to give a little bit of a caveat here. It's only if you're 70.5 or older. So if you are younger than 70.5, look at this as a future Christmas present coming down the way. But if you are 70.5 or older, you are allowed to donate up to $108,000 per year from your IRA to the charities of your choice. Okay. It is still 70.5. You're saying, well, wait, I thought the required distribution age changed. It did. This did not. That's the way that tax code changes work. They forget things. So the QCD is still at 70.5. You give the money directly from your IRA to charity. The check is written to the charity from your IRA. As a result, at tax time, you do not owe any income tax on that distribution from your traditional IRA. So if you are an individual who gives a lot to charity on an annual basis, this is certainly a strategy to look at. A couple of caveats. One is, it's not the year you turn 70.5, it's after you've turned 70.5. So you have to wait beyond that half birthday to start utilizing this strategy within a tax year. The other thing is to know that the tax form you'll get next February is not going to list that qualified charitable distribution. You need to note it. You need to keep it with your tax records. And when the tax software or your tax preparer asks you next year, did you make any qualified charitable distributions? You need to be careful to note, yes, I did, because that's where you're going to plug in whatever you gave. I wish they would change the tax document so that it would include a space that shows you made qualified charitable distributions during the year. It doesn't. All it says is that you took a distribution from your IRA. You're the one who has to remember that distribution was not taxable. It gets to be subtracted above the line. It's not a deduction. You're not putting it in your charitable giving. You're putting above the line. You're actually subtracting income that never gets counted. The added bonus, if you're age 73 or beyond, is that a qualified charitable distribution can go towards satisfying any required distribution you may have for the year. So if you need to take $50,000 out of your IRA this year and you want to give $20,000 to charity, give the $20,000 from the IRA. You now only need to take $30,000 out that will be subject to income tax. So that's, again, a very powerful above the line strategy. Let's talk about some below the line strategies. Let's review. Above the line strategy actually reduces or raises my income in the case of Roth conversions. Below the line strategies, we're looking at deductions. Okay. So how can we grow our deductions? First of all, what's our standard deduction? And there's been some major changes in the last 8 years to strategies because of how high the standard deduction is elevated to. For 2025, the standard deduction is $15,000 for single filers. It's $30,000 for married couples filing jointly. And if you're 65 or over, you can get an additional $1,600 to $2,000 depending on your filing status in additional standard deduction. So many people are not even subject to itemized deductions anymore. And this is something you need to be careful about, because I've talked with folks who have said, oh, I'm getting a full deduction on my taxes for my charitable giving. Maybe. Oftentimes you're giving all of those charitable deductions to your tax preparer. They're entering all of those numbers, and then the actual number that goes on your tax return is the standard deduction. So that's something to watch for. Is your charitable giving really helping? If not, there's some things we can do about that to maybe alter it. I'll talk about it a little later. Medical and dental expenses. Anything over 7.5% of your adjusted gross income helps. Another reason why those above the line strategies help. If I can get the adjusted gross income down, then 7.5% threshold drops, and more of my medical and dental expenses count towards my itemized deductions. There's no AGI threshold on charitable giving. There is not an AGI threshold, but a total dollar amount threshold that you may be aware of, the SALT tax limitation, state and local tax. Your property taxes, your state income taxes, and any local taxes you pay in aggregate can be deducted to no more than $10,000. There's a lot of movement being discussed in Congress this year. We'll see what happens there. But right now you are capped at $10,000. That's another reason why so many people are taking the standard deduction at this point. What's another way to save money below the line? This is going to not show up on your tax return. All right, this method that I'm about to talk to you about. but it is going to save you taxes over your lifetime in all likelihood. You can use appreciated securities to give to your favorite charities rather than giving cash. If you have appreciated securities, if you have Apple stock that you've been holding on to for 10 years and it's a 200, 300% gain, this could be a decision you make to use some of it to give to a charity of your choosing. Why? Because when I give in kind, I don't have to pay the capital gains tax. So I get the charitable deduction that I was always going to get, but I also avoid a capital gains tax that I was going to have to pay. The charity on its receiving end doesn't pay tax when it sells that security, so it can sell it right away. Lots of times you think, well, my charity's pretty small. I don't think that it would accept appreciated stock. Ask the question. I've seen some very small charities be willing to accept appreciated securities. Many of them have opened up brokerage accounts with institutions just because they know people like to give this way. And it may be a small brokerage account, but it doesn't matter. Once they have an account open, you can give to them into that account. You can get your full charitable contribution deduction, and you avoid a capital gains hit. The other thing I always have to talk about for those who are really in love with a stock, sometimes people say to you, that is just not going to make sense because I love that Apple. I'm never going to get rid of that Apple stock. That's fine. You should still use this strategy. The reason for that is you can take the cash you would have given to a charity and just buy more of the security you're giving. You're giving 100 shares of Apple to a charity. Fine, give it to the charity and take cash and buy another 100 shares of Apple. What you've done is you've elevated your cost basis in Apple from that point forward, which will lower your taxes if at some point you want to sell that stock. So using appreciated securities and charitable giving can make a big difference. We do have limitations. You see this bullet here at the bottom. You're limited to 30% of your adjusted gross income in doing this method, where it would be 60% if you were giving cash. All right, let's take that example of appreciated securities and expand on it because there's more we can do. We can bunch our charitable giving into a single tax year. So let's say I wanted to give appreciated securities. I want to give over the next 5 years, $20,000 per year. What I might want to utilize is a donor advised fund. You've probably heard about bunching, where you move 2 tax years of charitable giving into 1 year. But this donor advised tool is going to give us a lot more power, where we can do a whole series of tax years of giving in the current year. And to soup it up, use appreciated securities too, but cash would work for this strategy too. You put money into the donor advised fund to maximize your charitable deduction in this year. Once you've crossed over that standard deduction threshold, every dollar of your charitable giving is helping you until you get to those 30% or 60% tiers we talked about in the previous slide. Then you make grants from the donor advised fund over time. You can invest that account. Most people who used to do private foundations are actually using donor advised funds now. That would be again, that's a rabbit hole we're not going to go down in this time together, but if that's interesting to you, you should talk to someone about it. But you're going to get the whole tax deduction this year. You're going to give money out from it in future years. And that way you moved as much as possible to get tax benefit from your charitable giving. Very valuable when you're selling a business, right? Very valuable when you have a large one-time bonus that's going to be non-repeating, right? You had a huge sales year, you're a salesperson. So these spike years, if you sell a piece of real estate at a substantial gain, this could be a great year to use a donor advised fund. Why? Because this is a year where you're subject to higher income tax than you would normally be subject to. So getting every deduction you can get into this year is helpful. It's happening below the line, not above the line, but it can still make a big difference. So let me show you an example here. So this individual is going to make $150,000 in gifts over the course of 5 tax years. Option 1, the green option, is what they were thinking of doing, which is just giving like they normally give. However, option 2 says, let's give in this case, $150,000 of tax gift in this year. All right. And in the future years, why am I still getting the same deduction that I would have got otherwise? Why? Because I'm subject to the standard deduction in those years. So I still get very nice standard deductions those years. My giving in year 1 was not really helping me, or year 2 or year 3. I was never spiking above that $30,000 threshold. Now I do. All right. Bunching years of charitable donations into a single tax year is a huge below the line strategy. Let's talk a little bit about Secure Act 2.0, which is still having ripple effects throughout our lives. This was a major tax bill done by President Biden. We've had a lot of changes to taxes over the years. One of the big changes was in 2023, the required minimum distribution age moved from 72 to 73. There was Secure Act 1.0 that moved it to 72. Secure Act 2.0 moved it to 73. And actually, by year 2033, it's going to move to 75. So lots of changes to when you have to take money out. That just expands the window when you can take Roth conversions, to my mind. And then there's an excise penalty for required distributions that was reduced from 50% to 25%, with another reduction to 10% if you correct it in a timely manner. This was one of the worst penalties out there. If you missed a required distribution, you were penalized 50% tax. And in many cases, the IRS just waived it. Actually, I think that this might be likely to create more of a tax penalty, because I think they're being much more reluctant to honor a waiver altogether when the penalty is only 10% than they would if it had been 50%. Oftentimes, if you had good notes of how you missed it and why, they'd give you a one-time pass and just charge you 0% in penalty. 2024 changes. So like I say, ripples year by year. So Roth 401k pre-death required distributions were eliminated. This made so much sense. Why would you have to take money out of your Roth 401k to satisfy a required distribution when there was no tax dollars to the government? You didn't have to do a required distribution on a Roth IRA, but you did have to do it on a Roth 401k if you left your funds in a retirement plan. That was eliminated. And then they added a provision very valuable to college savers or post-college savers that remainder balances in 529 plans can be rolled over into a Roth IRA. Have all the details here. You have to have had the plan open for at least 15 years. You have to use contributions and earnings that came from more than 5 years ago. And the Roth IRA has to match the name of the beneficiary. But you can change the name of the beneficiary in a 529. So there's ways of routing money into the individual's Roth that you want to do that with. 5 years of doing it up to the maximum contributable. So right now that would mean a total of $35,000 that could be gifted from a 529 plan into a Roth. The other rule is that in those years, the individual cannot save using a Roth IRA. That has to count as their Roth contribution for the year, but in many cases, they're not anyway. So this can be very valuable. And now our last one, which I referenced earlier, the catch-up limit for ages 60 to 63 is now $11,250 instead of $7,500. So if you're in those tax years, lucky you, you get 4 years of being able to defer more income to post-retirement if you would like to. So now one more strategy that could be considered advanced. There are many advanced strategies. I'm just going to give you a flavor of what they could be. There's a charitable remainder trust or a charitable lead trust. This is in situations where either you want to provide income to your future heirs over a period of years, okay? Or you want to provide income to your charity over a period of years. In the first case, the remainder goes to the charity at the end. In the second case, where you're giving it to the charity over a period of years, then the children or whoever your beneficiaries are get the remainder at the end of that period. A way of getting a large charitable deduction in the current year, a little bit more complex. In many cases, somebody who is wanting to give to their university, but is tired of the phone calls that the university is giving them every 3 months. Will you give? Will you give? Yes, I've set up a charitable lead trust. It's going to be paying an amount every year to you as a charity. I don't want any phone calls anymore. You're getting money every year from me. And then the remainder at the end will go to your heirs. Or, you know what? I've already set up a vehicle for giving to you after a time period. I've got a charitable remainder trust. My beneficiaries are getting income from this. And at some future date, you're going to get a remainder bounce to you, Mr. Charity. Okay. So these are different strategies. Again, we're looking at those peak income years and how can we smooth out the tax bill. Business succession. I'm going to throw this in here because it's such an important topic. In a year that you're considering selling your business, you have to be strategic about your income. You can change the net dollar amount you're receiving from the business by a huge amount if you will be careful. So you want to make sure you have done a valuation of your business. You know what it's worth. You've identified what the capital gains tax liability will be. That's going to help you make better decisions. You're going to use that to do better estate planning. What deductions, trusts can I use? You want to look at tax strategies. How can I minimize capital gains from the sale of the business? Can I set the sale of the business to happen over multiple tax years? Can I use a donor advised fund to give a huge amount into the current year? In some situations, you can gift a portion of that business that you are selling into the donor advised fund prior to selling the business. So you get the double tax benefit that you would normally get in public markets. I was talking about earlier. You can get it on your private business. There's a lot of rules around that. I'm just throwing out ideas that see if it applies to your situation. But you could be able to donate a piece of your business to a donor advised fund to avoid a portion of the capital gain on the sale of your business. And then buy-sell agreements, this is just something good in general to have when we're considering business succession. We've contemplated what will happen if we hold the business at my date of death. We want to look at employee stock ownership plans. Is this a good way of transferring ownership in my business that is tax deductible to me? We want to look at the optimizing employee compensation and their benefits. How does that impact me from a tax perspective? And then, yes, whenever we're selling, we want to do due diligence of whoever's buying our company, and we want to make sure that the legal agreements are done right. This is a place where you can save money by not working with a strong professional and lose money long term, or you can pay some dollars now up front and actually end up, in my experience, getting much more over the long term. You have to evaluate the value creation for the dollars of cost. All right. We covered a lot of ground today. We talked about above the line deductions and covered a whole series of them. We talked about below the line deductions, how to expand our itemized deductions. And then we've talked about the sale of business, all kinds of things that you can save money on in taxes, none of which are good to be thinking about between February and April after the tax year is done. Very good to be thinking about during the tax year throughout, so that you can be thinking strategically and make proper plans. If you've had questions, please make sure in the survey afterwards today that you type that question into the survey. You will get an answer from someone who's going to give you a professional look at your situation and just at least do the best they can at weighing in elements that you want to consider. And obviously, if you'd like to schedule a 15-minute call with any of the advisors on the Savant team, we'd be more than happy to talk with you. Please don't hesitate to give us a call. That'll come up in the survey as well. So I do want to answer questions that have been posted today. I'm looking through and seeing what there are that we can cover in the time we've got left. And that's an adventure. So let's see here. Keep in mind, your question, if not answered during today, is going to be polled. We're going to make sure to get an answer to you. All right. Okay. Should I convert my 401k to a Roth while I'm in my working years? Okay. Maybe. The reason you would contribute to would convert traditional to Roth during your working years is if your income has gone down substantially already. If you're at the top, most people considering a Roth conversion are in their retirement years. The reason being they've had a big drop in their tax bracket. While they're at the top of their tax bracket, oftentimes what you're really looking for is a tax deduction. So you want to use the traditional approach to get money out of your current year taxable income into a future year. And that's what I would think you'd want to do with the 401k. I'm just thinking, like, if you've gone from an income of $150,000 a year down to an income of $20,000 a year, then yeah, that could be a good time to consider Roth conversions. Apart from that, I'd have to look at the specific case to weigh in more, but I would say generally you're going to want to wait until you're retired to do that. Okay. What happens with the donor advised fund once the money goes in there? I can't get any further tax deductions. Okay, two-part question. So let me answer the second part first. Yeah, you cannot get any further tax deductions once the money is into the donor advised fund. The reason is you got the full tax deduction at the time that you put the money in. Once you are giving money from the fund, the money is actually in a 501c3 at that point, set up by Schwab, Fidelity, American Endowment Foundation. Those are the three biggest ones I'm aware of. And they are actually a charity. So when you make a donation from a donor advised fund, that's really a grant that you're asking the donor advised fund to make on your behalf, and they will make it as long as it's to a registered 501c3. But then you also asked a question about what happens with the donor advised fund money once it's in there. You can choose how to invest it. You can make it very conservative, put it basically in a money market fund, cash. You can go all the way up to 100% stock. There's different reasons you would do each. Oftentimes, people who were using a private foundation in the past to do their charitable giving would have to make a 5% contribution to, entities over the course of each tax year. There was a required giving amount. There is no required giving amount from a donor advised fund. As a result, you can tend to skew it to a more aggressive allocation, leading to more growth over time. You just have to know that if you do that, you don't want to give funds out in a year that the markets are down, because then the portfolio is down. You take money out when the portfolio is down, just like your personal portfolio. You wouldn't want to do that. So you could just make sure you're only giving in years that the fund is up, and it would actually expand your ability to give in future years. The other thing to consider there is that it's not just appreciated securities you can give into a donor advised fund. You can give real estate, you can give artwork, you can give a collector's musical instrument. There's groups that will work with you on properly valuing those illiquid assets, accepting the asset, giving you the full charitable deduction for it, and then you sell it. They will sell it and put cash into your donor advised fund that you can use for giving. And also, if you are, for example, like a control person of a big company, and you're not allowed to sell stock, and you have highly appreciated stock in there, you could actually, some donor advised funds will accept that stock with a rule you give them that they can't sell any of those shares. They have to hold on to all of those shares to make sure that you don't run in afoul of any of the trading limits that you have on those shares, but you can still get the charitable deduction while you're in your working years, which tend to be the years where you get the most benefit from those kinds of gifts. So, all right, I think that covers the time we've got today. I do want to remind you to use the box that comes up in your survey to ask any questions I didn't have the time to answer. And I wish you best of luck on your tax strategic planning.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.